there's no question that something bigger is happening. I mean, there is no question about that, right? And a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze. Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, these short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this, and its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates, an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. when the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress, this is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffin's good at work. I don't know, I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released. Kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100.
There's no question about it, folks. Something big is happening, and if you've been paying attention, you already know it's bigger than just a little rally in gold and silver. It's systemic, it's structural, and it's showing us cracks in the global monetary foundation that people who've been in this market for decades, myself included, have never seen quite like this. And believe me, I've been screaming about this for a long time. Let's start with gold, because that's where the mainstream financial press always likes to begin. Gold is the headline grabber, the shiny rock that anchors central banks, currencies, and the public's imagination. Right now, speculators are rushing back into the gold market. You can see that in the COMEX data, where open interest is rising again. For those of you who don't live in this world every day, open interest is just a fancy way of saying the number of contracts out there, how many people are willing to put money on the table to buy or sell this metal. And when open interest rises, along with price, it's the classic picture of renewed speculative demand. Money is flowing back in, and it's pushing prices higher. But silver is a completely different beast right now. This is where it gets really interesting, and I want you to stay with me here, because the story is unlike anything we've seen in years. The silver rally isn't being driven by the usual suspects. It's not the hedge funds piling in, it's not the speculators running up leverage. What we're seeing is the unmistakable signature of a short squeeze. And that's not me saying it to sound dramatic. That's what the data says. Look at London. Lease rates, the cost to borrow silver, are at levels we haven't seen in decades. We're talking 5 to 6.5%. Normally, those rates are so low they barely register. A fraction of a percent, maybe 1% tops, even in times of stress. But now, 5, 6%. That's not just unusual, that's an emergency signal. That's the market screaming, there isn't enough silver to go around, and if you want it, you're going to pay through the nose to borrow it. Think about it in terms of stocks. If you want to short a stock, you've got to borrow the shares first, And if everybody's trying to short that same stock, the borrow cost skyrockets. That's what's happening here. It's Wall Street's version of a crowded fire escape. Too many people trying to squeeze through a very narrow exit. Now let me connect that with the delivery side. Open interest in silver is actually falling, so speculators are not rushing in. But at the same time, physical delivery demand is surging. Since late August, about 58 million ounces have been delivered on COMEX. Year to date, it's almost 11,000 tons. Folks, that's a serious amount of metal changing hands, and it's not hot money traders doing it. It's long-term buyers saying, we want the silver and we want it in hand. This is exactly what you get when liquidity starts drying up. Think about it. Shrinking availability of physical silver, soaring lease rates, and banks scrambling to cover their short positions. The bullion banks, especially in Europe, are stuck. They sold promises they can't easily deliver on, and now the cost of covering those promises is climbing fast. And here's the kicker. London is at the center of this storm. The LBMA, the London Bullion Market Association, clears about 600 million ounces of silver every single day. That's the paper trade. Contracts, swaps, derivatives. But against that, how much real, deliverable silver is actually sitting in vaults ready to go? About 140 million ounces. That's it. And a lot of that isn't even truly available because it's already spoken for, held by ETFs, sovereigns, or long-term investors who aren't about to part with it. So let's do the math. You've got between 1 and 2 billion ounces of paper claims floating around and only 140 million ounces to back them. What could possibly go wrong? Well, what goes wrong is what's happening right now. Lease rates explode, short sellers scramble, and physical demand collides with this mountain of paper. And you know what's fascinating? At the same time London is gasping for supply, the COMEX here in the US looks flush with metal. Remember when I kept saying during the tariff battles, this is not about tariffs. All that metal that came back into the US, that wasn't some accident. US banks saw what was happening, they brought the metal back home, and now they look like they're on solid footing.
And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39% when compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%, the S&P 67%, that's great. But just over the last 6 months where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through 400 bucks, I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month we are seeing huge deliveries into COMEX, and why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market. Not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history.
Let's start with the banks. We all know the LBMA is the center of the world's physical silver clearing. And when you've got 1 to 2 billion ounces of paper claims stacked against 140 million ounces of metal, you don't need to be a math genius to realize something's out of whack. That's a leverage ratio of at least 7 to 1, maybe as high as 14 to 1. Imagine a small-town bank with $1 in reserves for every $10 in deposits. That's not just risky, that's a setup for disaster. And that's the LBMA right now. Now ask yourself, what happens when the first big industrial player, say a Tesla or a solar panel manufacturer, says, "We want our silver and we want it delivered"? The whole house of cards shakes, and it's not hypothetical anymore. Lease rates at 6% are the market's way of saying, "We don't have the silver to lend. If you want it, you'll have to pry it out of our hands." But here's where it gets even more important. The European bullion banks are the ones most exposed to this crisis. And if you've been paying attention, Europe isn't exactly the picture of financial stability right now. Germany is already slipping into recession. French banks are under stress from souring commercial real estate loans. Italian debt is spiraling again. Add a bullion bank crisis on top of that. Folks, it's not out of the question that this triggers a wider banking panic. Remember 2008? It wasn't just Lehman. It was the interbank trust that collapsed. Nobody knew who was holding toxic assets, so the whole system froze. Well, substitute toxic mortgage bonds with undeliverable bullion contracts, and you see the parallel. Meanwhile, in the United States, the banks saw this coming. They pulled metal back from London, restocked their COMEX inventories, and hedged themselves better. It's not that they're saints, it's just that they've been burned before. So while Europe faces existential risk, US banks look stronger by comparison. That doesn't mean they're bulletproof, but it does mean the transatlantic imbalance is stark. Now let me connect this to monetary policy, because at the end of the day, the Fed is still the puppet master pulling strings in the background. Right now, rates are at 4.25% to 4.5%. And Powell keeps saying, "We're holding steady, inflation is sticky, we're not cutting yet." But history tells us something very different. Every time the Fed gets stuck between sticky inflation and slowing growth, stagflation, the path ends in rate cuts. Why? Because the debt is simply too big. Let me throw out a number, $35 trillion. That's the US national debt right now. And that's not even counting unfunded liabilities like Social Security or Medicare. At 4% interest rates, the US is paying north of $1.5 trillion a year just in interest. That's larger than the defense budget. That's larger than Medicaid. That's unsustainable. And you don't need to be a PhD economist to know how this story ends. They'll cut rates, they'll print, they'll inflate, because the alternative is default. And every time they do, gold and silver respond like rocket fuel. Go back to 2007 to 2011. Gold doubled, silver went from under $10 to almost $50. Go back to 2020 to 2021. Rates collapsed, gold surged, silver surged. The script doesn't change. The only difference this time is the starting point. A global system already wobbling and silver already in shortage. Let me pause for a moment with a bit of levity, because I know this gets heavy. A friend of mine sent me a meme the other day. A guy sitting at a diner counter, coffee in hand, with the caption, "Waiting for $50 silver so I can finally quit my job." And the waitress is leaning over saying, "Honey, at $50 silver, you'll be working overtime just to find a dealer with any left." That's the reality. When it finally blows, the metal won't be available. Now let's add in geopolitics because this matters too. Look east. China and Russia are stacking gold like it's going out of style. Just in the last year, China added over 300 tons of gold to its official reserves. That's the official number, by the way. The real figure is probably much higher. Russia? Same story. They've been cut off from the dollar system, so they've doubled down on gold. Why? Because gold is the one reserve asset nobody can sanction. But here's the underreported part. While the East hoards gold, they're also stockpiling silver quietly. China dominates global solar production. That's a silver-intensive industry. They're locking up supply not just for investment, but for industrial necessity. That means less silver available for the rest of the world. And this is where silver's unique role as both an industrial metal and a monetary metal comes into play. It's not just investors buying. It's not just governments buying. It's factories, automakers, and solar producers buying. That's why silver is so explosive. Let me bring in a headline I saw last week in Reuters. Global solar capacity expected to surge 30% in 2025. Do you know what that means for silver demand? Each gigawatt of solar capacity uses around 20 metric tons of silver. Multiply that across global installations, and you're looking at hundreds of millions of ounces per year just for solar. Add in EVs, electronics, medical applications, and you realize the industrial demand alone could consume annual mine supply. Speaking of mine supply, let's talk production. Global silver mine output is around 820 million ounces a year. Sounds like a lot, right? Until you realize industrial demand is gobbling up close to 600 million ounces annually. Add in investment demand, coins, bars, ETFs, and you're already in deficit. In fact, the Silver Institute reported 3 consecutive years of supply deficit, with 2024 seeing the largest on record, over 250 million ounces. That's not a small gap you paper over. That's a canyon. And here's the kicker. Bringing new silver mines online isn't easy. Most silver is a byproduct of copper, lead, and zinc mining. So unless those industries expand, silver production won't surge. And even if it did, it takes years, sometimes decades, to bring new mines to market. So the idea that supply will magically appear to meet this demand spike is fantasy. And let me leave you with one last bit of humor, because if we don't laugh, we'll cry. A guy on Reddit posted, "I asked my girlfriend if she wanted silver or flowers for Valentine's Day. She said flowers. I bought silver anyway. She dumped me. But at least I can buy my own flowers when silver hits $100, folks. That's the trade-off." And I'd say he made the right choice. So here's the bottom line. Silver is the most undervalued, underappreciated, strategically critical asset in the world right now. The setup is historic. The supply is vanishing. The demand is rising. The banks are trapped. And the Fed is cornered. When you put that all together, you don't just have an investment. You have an opportunity of a lifetime. Don't miss it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.